Policy and Profits. I'm Antoni. I like to play an economist on TV. More importantly, I am joined by the one, the only trader extraordinaire, Wall Street aficionado, founder and head of Ascalon 6 Capital, Antony Esposito. Anthony, how's it going today?
EJ, that never gets old, my friend. I appreciate the intro. We're doing well. We're doing well. We are chugging along through a volatile and aggressive market, which is good. All's good here. Very happy with the results. Very happy with the year so far. It's been a little crazy, but fun. How are you doing? I know you're in the thick of it on your end, and I continue to watch the posts and see you charting and tapping away. So what's going on your end, and how is everything?
Well, crazy busy. A lot of travel, a lot of meetings around the country, keeping me busy. And then obviously the slew of data coming in, which is a that's always happening, right? But it's just amazing right now how much things are changing as a result of what's going on overseas, as a result of oil markets, most specifically, but other things as well. Whether it's the knock-on effects in helium, in sulfuric acid, in aluminum, I mean, you name it, the list just goes on and on. So again, it's not just a matter of the speed at which we get data releases, because that never changes, but it's within these data releases how much things have changed and how much we need to revise forecasts every time we get a new piece of information. These aren't small revisions we're talking about. It's big swings. So, and I think all that complements probably what you're seeing and what you're working with, Anthony, with all the big swings we see in the market, right? Whether it's in equities or bonds, you name it.
Yeah, it definitely, especially this past week, even though the we're still in that de-escalation and that kind of that stalemate phase as far as Iran goes. We're heading into earnings season. We're heading through earnings season, and we are seeing a lot of volatility underneath the hood. So the chart's going bottom left to upper right, and everyone's saying this is great. We're hitting all-time highs across the board, individual names, and the index now. S&P 500 futures, ticked at 7,300 now. So we're definitely seeing a lot of volatility under the hood, even though things are going to all-time highs and there's a de-escalation or a stalemate. So, for example, we've had the 10-year back above 4.4 this week, which is kind of like a flashing yellow, if not approaching flashing red. As far as yields go, gold has been extremely whippy. We've had WTI and Brent spike back up towards highs kind of out of the blue, and not a lot of information as to why. We had the UAE step out of OPEC. We've had some movement as far as headlines on releases from the Strategic Reserve, which are actually old headlines. So a lot of volatility under the hood within the bars, but the bars are moving bottom left to upper right. So we're continuing that grind. One thing that we've focused on, and one thing that I've noticed you've been on, has been consumer sentiment. We're going to put up a post that you had out on X as far as present situation and expectations index for consumer sentiment. We do have an economy that is truly relying on the consumer, and everything that we discuss is where is the consumer, where will the consumer be, and will the consumer continue to spend and really drive GDP growth and spending within the country. So let's pull up that chart. It's the present situation and expectations index. Can you go through this a little bit with me? What are you seeing now, and what are you seeing kind of stepping out in the near future, in the next quarter, 2 quarters, say?
Well, I think one of the big things that we've seen, Anthony, is that we never actually had a true recovery after COVID. You can see it's really obvious on this chart where things fall apart during COVID. Not so much in terms of consumers' expectations, in other words, where we think we're going to be a year from now or further into the future, whatever the case may be, but in terms of how people are doing today. Yes, there's a spike back up initially in 2020, much more so in 2021, but you never actually get to where we were before COVID. And in fact, it's erratic, but it's a slight downward trend, and that trend accelerates in 2024 and gets worse. It picks up a bit at the end of 2024, but then in 2025, you're back down on that downward trend. And then if you look at expectations, that has been below a key metric where you traditionally have a recession signal. Now, obviously, we're not in a recession today, but unfortunately, people's situation is bad enough and they expect it to get worse, so much so that it is usually what correlates with recession. The big story here, I think, is just inflation. It's the fact that if you look at what people's paychecks can actually buy, and this is something you and I have talked about a lot over the last couple of years, if you look at what people's paychecks can actually buy, that is still lower than it was at the start of 2021. So although it was getting better after summer of 2022, it has been trending upward. It has yet to recover. So people are still behind, if you want to look at it that way. People's cost of living is up. People's standard of living is down compared to 5 years ago. Shocking, but it's true. People, it's much like the lost decade in the 70s, right? With oil prices spiking and all of the other chaos that was happening at that time, economically speaking, people went backwards. And it wasn't until the Reagan years that households actually recovered, that they could afford literally what they had a decade ago, that their retirement savings were worth what they were a decade ago. You inflation adjust the major stock indices. And again, for a decade, people lost ground, and it took a long time to actually recover that. So I think that's what people have been dealing with. That's why you've seen the lousy consumer confidence numbers that we've had, not just for the last year, for the last 5 years. Again, it's been since COVID. And you can see, as when you look at expectations here, that follows pretty tightly, not perfect one-to-one, but it follows pretty tightly what's going on with prices, specifically energy prices. And just like when you had the big spike under Biden, you had worse numbers on this chart. Now today you're seeing exactly the same thing. I think it's just really a repeat of the same old story.
So let me ask you this, and I want to dig into this because this is we always talk about inflation, and I think most people don't realize that when you say inflation is coming down, most people think it means that prices are coming down. It doesn't. It means that prices are going up at a slower rate than they were previously. And we actually have a Fed, and I've talked about this before, and it's a equity futures traders view, but we have a Fed that's targeting 2% inflation. So they're targeting for the prices to go up 2% annually in perpetuity. And I don't understand why that actually is our target. I still don't. But just to dig into this, if this is inflation, how do we reconcile the price change? So inflation being what it is, over the Biden years, we had a massive spike up to 12% of inflation. Inflation has come back down. Over the course of those 4 years, we saw a net price increase across the board for a basket of goods at about 25 to 30%. So everything costs, on a broad stroke, your life costs 25 to 30% more to live. How do we get those numbers? Because now I don't want to talk about inflation for a second. I want to talk about the price of living, the cost of goods. Mm-hmm. Do the cost of goods actually come down? What side of the equation do we need to work on? Can we work on? Will we work on? So that these present situation and expectations turn back up, things are truly more affordable, and people are actually bringing dollars home and sitting at their kitchen table, and the dollars are worth enough to get through the day and the week and the month and be okay, and not lie in bed at night staring at the ceiling. What do we need to change here?
So Anthony, this is part of why I just, as an economist, the national security stuff aside, this is part of why I look at the Iran war right now as kind of a tragedy. When we go through different price indices for food and for a lot of consumer staples that you get at the grocery store, we were actually seeing the rate of inflation not only come down, but hit zero. In other words, prices aren't going up at all. A couple of things had actually started to go negative in terms of their inflation rate. And that's when you get the phenomenon of deflation, what you're talking about, where prices are now going down. And there were a bunch of other foodstuffs where you saw the exact same pattern, and they were just a little delayed. In other words, inflation had basically stopped, and we were going to start seeing prices come down in the coming months. Now, the problem is with oil going up so much, with fertilizer going up so much, again, all as a result of what's going on overseas, all that progress has stopped and it's reversed. In other words, we're back to seeing price increases for those things. And so, what I think would have been a summer and an autumn with lower food prices and with relief for the consumer, unfortunately, has turned into another round of price increases. And we saw this in the month of March when we got the inflation adjusted weekly earnings. In other words, this is what the average American's weekly paycheck can actually buy, not just how big the paycheck is. And instead of continuing the good progress we saw during the first year of the Trump administration, where those real earnings were rising, it fell pretty dramatically. It wiped out all like a half a year worth of gains, unfortunately, and that was strictly almost entirely from gas prices going up before the food inflation hit, which we'll see some of that in the April report and then more in subsequent reports. The April report should be out this coming Friday. So, unfortunately, what's it going to take now to get back to making good progress? I think you're going to have to you're going to have to just wrap up this war overseas, and I'm not sure how exactly that happens. I don't know what that looks like. I don't know what the off ramp is right now for the conflict. That's outside of my wheelhouse. But I do know you're going to need to see the conflict wrapped up, because you're going to need to see the Strait of Hormuz open so that you can get 1/5 of the world's oil supply flowing again. And look, the UAE leaving OPEC, I think, is great news. And I think one of the reasons why they're doing that is the anticipation of when this conflict ends. All these nations around the world, including us, who have been dipping into their strategic, in our case, we call it the Strategic Petroleum Reserve, but everybody's got reserves, right? Japan's are massive. All these nations are using their reserves to replace their lost oil imports right now, right? We're not even using the reserve to replace our lost imports. We're using the reserve to send overseas. It's all, literally every drop of it's getting sent overseas right now. It's all being sold as exports. All of those nations, us included, Anthony, are going to have to replenish all those stockpiles, right, when this war concludes. It's going to be a massive increase in demand. Well, if you're part of the cartel, the OPEC cartel, guess what? The cartel is going to tell you how much you have to limit your production. They don't want to do that. Yeah. So I think this move by the UAE is good for them, very, very good for them, but it's also good for the rest of the world, I think, including us, because it's going to help increase production when this war is over. They probably have an extra 1 million barrels that they can pump. They can probably go from about 4 a day to 5 a day. So that's going to be really, really good news for global supply, and helping to meet that surge in demand should help keep a bit of a lid on prices when the time comes.
Yeah. Yeah. And I know their break even, I was looking at it yesterday, a second point for them is their break even is well below the Saudis break even. So if the Saudis break even is 60 a barrel and they're down at 40 a barrel, they're beholden to keep, to try and focus on that 60 level because of the Saudis. Whereas if they step back from OPEC, they can produce more, they can sell it cheaper, and they can benefit themselves more, which benefits the global pricing. So even there, they're positioning themselves well, and it will benefit the world economy as far as price. There's no question. We'll get to a spot where I remember back trading futures years ago where we had gone negative in term structure, where they were paying you to take delivery, but that's another story. I don't know that we'll get there now. As we move out further into the cost of living, inflation, and pricing, you had another post out on housing, which I think is important to touch on because it really is a major factor. It is the main investment, the largest investment on average across America is our home. Where are we here? You did a nice analysis here, 24 to 25, and then 25 to 26 as far as price changes. How does this look, and is housing moving towards affordable, and why or why not? Are we going to get to a spot where that, and you do some great work as well on that gap between median income and median cost of a house, and how well over? I think right now we're 42% over, meaning pricing on the median cost of a home is 42% more than the median income in the country, and that gap is where the pain is. What is this looking like, and does it improve? But it's improving, but how do we get back to where that gap is closed?
Yeah, great question. And yeah, I mean, the gap is so bad, Anthony, if you want to look at like financing, which obviously that's how almost everybody buys a home, right?
Yeah.
With financing, frequently depends on obviously on which metro you're looking at, but I think the national average is something like a third. In other words, the median household income would have to increase by about a third before they're even going to qualify for the loan on a median price home. So I mean, it's so ridiculously far outside of their price range. It helps explain this frozen over housing market, and you do have a lot of people still sitting on very low interest rates, interest rate mortgages, which they're going to lose because these things are typically not transferable. So again, unless sellers realize they can't get for their home what they paid for it in a lot of instances, the market's just going to stay frozen. Now, you do have a few places around the country where that has happened. In other words, sellers have just been forced to say, you know what, I got to take a haircut, or maybe I just got to sell for what I paid for it. I'm not going to see any increase in terms of the equity there. And it's because you're looking at places like, in Texas, there's Austin, there's Dallas. In Florida, you have Tampa, Miami. Arizona is another one, I think, Phoenix to a lesser extent. All the cities I'm mentioning, Anthony, are ones where they have been building like crazy. They've just been going gangbusters, whether it's apartments, whether it's single family homes. And the result of that huge increase in supply has actually been that they've been driving down the price on new construction so much that the price of existing homes has been forced to follow. And oftentimes the dynamic works exactly the other way. But in this case, you've seen, especially in those markets, the price on new construction falls so far below existing homes that again, it's dragging the ladder down with it. And that's where you're starting to see some real affordability. It's the increase in supply that's really helping to drive down prices.
And has deregulation played a big part in this? I know we kind of, so you think about it like the lower end, the middle market, and then the upper end in building. So think about it like the stock market, right? Small caps, mid caps, and large caps. The regulations under Biden really squeezed out the builders from building in that middle income portion because of the additional costs that they had to take on to be compliant with regulations, overbearing regulations under Biden. Those builders then decided we're not going to build 3 or 4 mid cap houses. We're going to build 2 or 1 large cap houses and make it worthwhile on balance to sell that house versus trying to make a smaller margin on the median or the middle market house. Has the deregulation under Trump, is that helping bring supply on in that middle price point where most Americans are going to look to buy the home?
Yeah, it's certainly helping, Anthony. Absolutely. It's not a silver bullet, simply from a time standpoint. You
Yeah.
implement one of these regulations, you have to go through the whole comment period. It's not as if you can, flip a switch, but it is starting to help. And then, of course, you have to go through permitting and everything, and then the actual construction. So it could be several years before somebody in the admin makes an announcement and your first increase in supply actually comes to market. But
Okay.
you are seeing a bit of a pickup nationwide. However, the bigger difference right now that we're seeing, and listeners and viewers could probably tell from the cities that I mentioned, where are they? It's all red states,
Yeah.
right? And,
Yeah.
and they're all more conservative leaning metros. This isn't New York. This isn't Chicago. This isn't LA or San Francisco and any of those, right? It's not Boston. The places with the worst housing regulation are also the ones that have seen prices stay stubbornly high. And it's the ones that have loosened the regulations that have been, a lot easier when it comes to permits, to zoning.
Yeah.
Those are the ones where the housing market's doing better. I mean, look at Houston. I didn't mention Houston because they never had as much of a crisis as those other places did to begin with. Houston has been building for decades and simply never stopped. Right. This is why when you go to Houston, the city, I mean, the city just goes and goes and goes and goes. They virtually don't even have zoning laws. It's incredible. They have one of the most price elastic housing markets in the country. So Again, all this to say, and to your point, Anthony, regulation has a lot to do with this, and we can tell that not just from looking at the nationwide data, but when we break it apart by municipality.
Okay. All right. So regulations, rates obviously goes without saying, major part.
Yeah.
And I would kind of piggyback onto your state versus blue state and say not only do the blue states with higher prices have worse regulations and they're more restrictive, they also have these sanctuary cities, and they're essentially increasing the demand for housing, which is actually, in my view, I'll call it artificial. That demand
Hmm.
should not be here. The space being used for illegal aliens and housing, and that shouldn't even be in place. So if you removed that, in theory, you would remove demand, and you would have, even on equal supply, prices would come down. If you remove that and you increase supply, or you had equal supply with lower regulations, lower cost, prices would come down. So when the Dems get up and pound the table about the cost of living, which, by the way, was not even a topic during President Biden, there was no inflation, there was no increase of the cost of living. We stand with Ukraine at gas at the pump at 5 on a national average. Now it's at 405, and everyone's freaking out. So I mean, the policies matter, and I just want to point that out. That I think you make a good point. Red state versus blue state. This is just math. This is all quantifiable. It doesn't matter what your view is on any hot topic of the day politically. This is just math. You look at the red states, you look at the blue states, and you can see where the policies work and where they don't work. I want to shift gears really quickly. The market has obviously been on a tear. As I said, we're at all-time highs across the board. What I want to talk about is we went through that weekly chart for months and gave the downside targets, which were down 10%, 8 to 10% from where we were talking about it. So they were really good targets for the S&P, down at 6,400 in the front month futures. Now we see the front month futures up near 7,300. I don't want to be a hater. I don't want to say we can't go higher. We can go higher. I don't want to say that there's a bubble that's going to explode this week. I'm not saying that at all. What I am saying with this portion of the show is you want to start to identify where leverage is out of control. You want to
Hmm.
start to identify where the risk is, even if you have a sector, and in this case, I'm going to pick out the semiconductors. We have $100 billion now for the first time in semi ETFs. Okay. Now, what does that mean? It means that we are very, very invested. The greatest gap between the S&P and the semis since 2000. Everyone knows what happened right after 2000. What I want to focus on here is when you look for potential weakness, potential bubbles, potential downside risks that maybe are not being quantified or considered, one of the things you want to look at is leverage. The semi ETFs are highly levered. There are a number of highly levered semi ETFs that are getting a ton of money pushed in, meaning for every one share you're buying, you're getting levered into 2 times, 3 times exposure. And that's great. But what that does is it creates a massive spike up. And when you come out, every time you sell, or a retail seller sells, or an institutional sells, every one tick down, or one, hitting the button one time counts for 2 or 3 times. So that move down is going to be equally as aggressive, if not more. I want to point out the massive amount of capital that is pumped into these semi ETFs, the massive amount of capital that is in the semi ETFs now, 100 billion plus, and the fact that a lot of that capital is levered 2 times, 3 times through these derivative products. So everything looks great. Earnings are going fine. S&P is at all-time highs. Large cap tech is back in vogue after a quick hiatus, in Jan, Feb. But be careful when you see massive leverage, and there is undeniably massive leverage in the semiconductors and specifically in these ETFs trades. So as we move through, this is a flashing orange. It's not a flashing red. I'm not saying tomorrow this implodes, but if you're going to look for a spot to be cautious, at this point, I would be very cautious with the semis. I understand the earnings growth and the trajectory and AI and the chip sales, and I do. But I do think that when you see leverage like this, you need to take a pause and just think for a second. Just take a second and think about what the downside risk is here versus what your upside potential is at this point. So The profit portion of the show today is look for leverage when you want to find a bubble or you want to find where the risk is. And right now, I'm seeing an exorbitant amount of leverage in the semiconductors. So just keep an eye out.
And Anthony, to that point, I mean, it's crazy when I look at the number of construction projects related to this, things like data centers that have been canceled this year. And, a lot of that has to do with higher energy prices. I get it. But I mean, it really is amazing. Something like half the projects that were active on January 1 are no longer, meaning they've either been canceled or at least put on pause. I mean, that's active construction that's not happening right now. So definitely a cause for investigation, if not alarm, right?
Yeah, I would agree with that. I also think, and this is, look, we're technical analysts here, right? So we're trading a momentum trend model in the future space, obviously paying attention to tech and large cap tech. I would add to your concern the fact that we now see a company like Meta going out into the debt market to raise capital versus them having cash on hand for their capex. So not that that's necessarily a bad thing, but we are starting to see large cap tech go out and offer more fixed income, more debt in order to finance their spend on these projects. So I think it all circles back to, are we ahead of our skis? I don't think anyone is questioning technology, AI, regardless of what the benefits or the risks are, is here to stay. But the question is are we way ahead of our skis as far as spending and as far as what the return on that investment is going to be? And when you see projects being canceled, and when you see, in my view, in my opinion, when you see companies needing to issue debt in order to spend what they need to spend in order to keep pace with the growth, if that growth trajectory changes, if that slope changes, then we could be in for quite a bit of a break. So all things to consider, I think it's really important to be, the trend is your friend. It's important to be with the market. You're in the market to make money, not to be right or wrong. But I would say, as you see the tea leaves, it's always good to just take a step back and pay attention to them. Always good to take a step back and think about what you're seeing and write it down. Take some notes and just be able to objectively look at where the risk and the opportunity may be, and take opportunity, manage your risk, and it'll be difficult, but you should be okay.
Yeah, and to your point on going into the debt markets, Anthony, I think that's such a great observation given where interest rates are today, right? When you had the big tech companies in 2000 and even into 2021, and they're going into the debt market, they were doing so at such obscenely low rates that some of them, I think Apple was one example, they were basically just taking on this debt and then buying back their own stock because the dividend yield was higher than the interest rate on the debt. So, in that case, it was just an indication of how insanely well capitalized they were and nothing else. Versus today, your observation, I think, is really, really valuable. Again, given where interest rates are, that tells you a lot.
Well, I would end on this note, and you hit on a great point. The buybacks that we've seen over the past 20 years and inflation are the growth in the S&P. That hard stop. If you take out inflation and you take out the fact, first of all, inflation accounts for about 60% of earnings growth across the board in the S&P 500. That's insane. And if you take out the fact that we have consistently seen the buybacks occur across the board, which are reducing the outstanding shares, which are increasing earnings per share. If you remove those two things, you have seen anemic growth in the S&P 500 as far as earnings go. It's a real problem. And if we hit a spot where we start to see new issues come on and there's more issues tradable, it could actually create pressure down on the index versus an upward pressure on the index based on earnings. So these are things to consider. I think the use of capital and the use of debt to buy back shares has been very strategic. It's been done across the board in every sector. It's been done for 2 decades. And it's created somewhat of a smokescreen as far as what earnings growth really is. And if you combine that with inflation, it's a conversation no one has, but it's a real thing. Now, I'm not saying that the S&P won't go to 8,000. It will at some point. I'm just saying if you want to have an honest conversation about where earnings growth has come from, it's inflation and it's buybacks. There's no question. That's just math.
Nice dose of reality to end on, Anthony.
Listen, man, have a great night. Thank you so much. Always a pleasure. At Real EJ Antoni, you're the man. I appreciate you. Appreciate the handle. At CMT_Anthony, if anyone wants to check either one of us out. You can also see me on the website at Ascalon6capital.com. Always happy to hear your comments on X or on email, anthony.esposito@Ascalon6capital.com. EJ, always a pleasure, my friend. Have a great night, and I'll talk to you soon.
Till then, Anthony.